A nearly $20 surge in crude oil prices is threatening India's economic stability. This explainer covers the macroeconomic dominoes of a widening trade deficit and a weakening rupee, the government's fiscal trilemma with three painful choices, and the stock market fallout, identifying the key corporate winners and losers. By the end of this analysis, you will understand the cascading risks of this oil shock on the Indian economy.
The entire problem begins with a fundamental mismatch. Every year, the government drafts its national budget based on an assumed price for crude oil. This year, however, global events have completely shattered those assumptions, creating a massive gap between the plan and the new reality.
This chart lays out the core issue. The budget was built on a forecast of oil at roughly $62 a barrel. Today, prices are hovering near $80. This isn't a minor fluctuation. This $18 gap represents a multi-billion-dollar hole in the national budget, and it forces a complete reassessment of the country's economic health. So what happens when the price of your single largest import skyrockets? It sets off a chain reaction, a series of macroeconomic dominoes that begin to fall, one after another, starting right at the nation's trade balance.
To really understand the scale of this, let's put a hard number to it. For every sustained $10 increase in the price of crude, what is the direct, bottom-line cost to India's import bill over the course of a year?
The number is staggering, between 13 and 15 billion additional dollars. That's a direct hit to the country's foreign exchange reserves. This massive outflow of cash widens the current account deficit, or CAD, by roughly half a percentage point of GDP. And that leads immediately to the next domino.
This is straightforward supply and demand. As India is forced to buy more US dollars to pay for expensive oil, the value of the rupee falls in comparison. But this isn't just a simple currency adjustment. It's the beginning of a very dangerous feedback loop.
This is what economists call a vicious cycle. India needs more dollars for oil imports, which weakens the rupee. But a weaker rupee means you need even more rupees to buy a single dollar, which makes the next barrel of oil even more expensive. It's a self-reinforcing problem that becomes incredibly difficult to escape.
Now, as the cost of energy imports rises and the currency weakens, that pressure inevitably spills over from the nation's balance sheet to the household budget. The next domino to fall is domestic inflation. There's a direct and measurable correlation here. For every $10 rise in crude oil prices, the Consumer Price Index, or CPI, is projected to increase by 25 to 35 basis points. This isn't just about what you pay for petrol. It means higher transport costs for food, for manufactured goods, for all services, leading to a broad-based increase in the cost of living.
And this puts the Reserve Bank of India in an incredibly difficult position. Any hope for interest rate cuts to stimulate economic growth begins to evaporate. In fact, if inflation climbs too high, the central bank may be forced to do the opposite, raise interest rates to contain it, which in turn risks slowing down the entire economy.
This brings us to the government itself, now caught in what can only be described as a fiscal trilemma. It must respond to these rising prices, but every available option comes with a significant and painful trade-off. There are simply no easy answers. The government is essentially facing three bad choices. Option 1. Raise fuel prices and pass the entire cost to consumers, but that directly fuels higher inflation. Option 2. Cut taxes, like the excise duty, and absorb the cost itself, but that blows a massive hole in the national budget. Or Option 3. Force state-owned oil companies to absorb the losses, which craters their profitability and damages their long-term financial health. To understand the high price of that second option, just look at this figure. For every single rupee the government cuts from the excise duty on fuel, it loses about 15,000 crore rupees in annual revenue. That makes any tax cut an extremely expensive and difficult policy choice. Of course, this pressure doesn't stop at the government level. It flows directly into the corporate sector. For many industries, crude oil isn't just fuel, it's a primary raw material. When its price spikes, their profit margins get squeezed hard. Certain sectors are right on the front lines. For airlines, fuel can represent up to 40% of their total operating costs. Paint and chemical companies are heavily dependent on crude oil derivatives for their products. And obviously, logistics and tire companies are directly hit by higher costs for both fuel and petroleum-based raw materials. For all of them, higher oil prices mean lower profits. Now, when you combine rising inflation for consumers with falling profit margins for companies, you get a clear recipe for an economic slowdown. People have less discretionary income, and companies have less to invest. This combination can put a serious brake on overall consumption and economic growth.
So finally, let's translate all of this into what it means for the stock market. In any major economic shift, there are going to be clear winners and losers, and this oil shock is no exception. It creates both significant risk and, for some, potential opportunity.
On the at-risk side are the direct consumers of oil. This includes the oil marketing companies like IOC and BPCL, especially if they can't pass on costs. It includes the entire aviation sector and the paint, chemical, and logistics industries we just talked about. But on the other side are the producers. Upstream companies like ONGC and Oil India that extract and sell crude see their revenues soar. And even complex refiners like Reliance can potentially benefit from higher margins in such a volatile market. But there's a huge caveat for those potential beneficiaries. The government is watching very closely. If upstream producers start making what could be considered undue profits from this crisis, the government could step in with a special windfall tax. This would effectively cap the upside for those companies, using their gains to offset the government's own rising deficits.
With the price of oil largely dictated by global forces, the ultimate question is this: can India's policymakers navigate the fallout without sacrificing the country's economic growth, its financial stability, or the health of its core industries? Answering that challenge is now their central test.